20%. That's the share of the world's oil that flows through a strip of water just 21 miles wide. Not a pipeline, not a refinery. A strait. A waterway most people couldn't find on a map. And right now, it may be quietly raising your grocery bill, rattling your retirement account, and reshaping the economy your children will inherit. Who bears the cost first? You? Or the generation just starting out? Think of it like a single valve on a city's main water line. One valve. The whole city depends on it. And someone's hand is hovering near the switch. $112. That's where Brent crude, the global oil benchmark, was trading as of late March 2026, up more than 50% from a year ago. For a family in Ohio, a retired teacher in Florida, a couple in their 50s trying to protect what they've saved, that number is not an abstraction. It's showing up at the pump, at the checkout line, in the quiet erosion of purchasing power that doesn't announce itself. It just arrives. But this story is bigger than one family's budget. Here's what most people want: stability, a retirement that holds, groceries that don't jump 15% in a year, a world their kids can afford to enter. What's blocking that? A 21-mile bottleneck between Iran and the Arabian Peninsula, the Strait of Hormuz, where roughly 20% of the world's oil and about 25% of seaborne oil trade passes every single day. And the price of that stability? Potentially higher than most people realize. Because when that flow gets threatened, not blocked, just threatened, global markets don't wait for confirmation. They price in fear first. Here's the belief most people carry. The US produces its own oil now. We're energy independent. What happens in the Middle East stays in the Middle East. And that belief isn't entirely wrong. American oil production is real. The numbers are real. But oil is priced in a global market. It's benchmarked internationally. If Hormuz disruptions push Brent crude to $130 or $140 a barrel, domestic fuel prices follow, regardless of where the oil came from. The local gas station doesn't care where the oil was drilled. It cares what the global market says it's worth. So the belief breaks down here. Physical independence does not equal price independence. The equilibrium most people assumed, that domestic production shields them, may not be as protective as it looks. And this isn't one family's problem. In 1973, Arab nations cut oil exports to the US. Gas lines stretched around the block. Prices doubled. The stock market lost nearly half its value. In 1990, Iraq's invasion of Kuwait sent oil spiking. Recession followed. In 2003, conflict in the region pushed prices up again. The same sectors felt it: airlines, manufacturing, retail. The pattern is consistent. Energy shock leads to supply chain pressure, to consumer inflation, to market volatility. What's different in 2026 is the mechanism. Decades ago, blocking a strait required large-scale naval force. Today, lower-cost tools, drones, asymmetric threats may be capable of threatening targets worth far more. That shift alone is why markets appear increasingly sensitive. The cost of disruption has dropped. The scale of potential damage has not. Here's how the system actually works, stripped of jargon. Oil is the base input for almost everything that moves. Trucks, ships, trains, planes. When oil goes up, the cost of moving goods goes up. When the cost of moving goes up, prices on shelves go up. Economists estimate that every $10 increase in oil adds roughly 0.2% to inflation. A $40 move, which has already happened, could add nearly a full percentage point of inflation on top of existing pressures. Now layer in natural gas. Prices there have also been rising alongside regional tensions. Natural gas feeds into ammonia production. Ammonia is essential for fertilizer. Fertilizer costs rise, leads to food production costs rise, leads to grocery prices rise. It's a cascade, not a single event, a mechanical sequence. Think of it like a line of dominoes. But the first domino is 21 miles wide, sits in the Middle East, and most people have never heard its name. Now ask, what happens if this continues? In 5 years, if energy markets remain structurally elevated, the households most exposed won't be the wealthy. They'll be the middle class and the retirees living on fixed returns. In 10 years, the children entering the workforce today will be buying homes, starting families, building savings, in an economy potentially shaped by compounding energy costs, elevated food prices, and the long tail of inflationary pressure. Here's the twist most people miss. The U.S. national debt now exceeds 120% of GDP. In past oil shocks, 1973, 1990, governments had fiscal room to absorb the hit. Stimulus, emergency spending, strategic releases. That room is narrower now. Efforts to offset higher energy costs could, in some scenarios, place additional pressure on the dollar, which has already shown volatility. The real problem isn't just Hormuz. It's that the buffers we relied on last time may be smaller this time. So why does this keep happening? Because the incentive structure of global energy markets rewards proximity to supply, not insulation from disruption. Nations that control choke points, or can credibly threaten them, hold leverage that doesn't require armies. It requires geography and timing. And markets, by design, price in risk before it materializes. That's not irrational, that's how pricing works. But it means everyday consumers absorb cost increases based on probabilities, not confirmed events. It's like paying higher insurance premiums because your neighbor started keeping gasoline in the garage. Nothing is burned yet, but the risk profile of the neighborhood just changed. In economics, that's called a risk premium. And right now, a significant one may be embedded in the price of nearly everything you buy. Now let's ask harder questions. What is the real problem? Is it the Strait of Hormuz? Or is it a global pricing system so interconnected that a single geographic point can transmit economic shock to a family in Ohio within weeks? What assumption is going unexamined? That geopolitical instability is temporary, that prices will normalize, that past recovery timelines apply to present conditions. Who benefits from the current system? Energy producers, nations with pricing leverage, institutional investors positioned in commodities and energy stocks, many of whom may already be rotating into those sectors quietly. What if the temporary assumption is wrong? What if elevated energy costs become the structural baseline for the next decade? Not the exception, but the new floor. Then the question isn't whether to respond, it's whether you've been thinking about it long enough to respond clearly. Here's the larger question this raises, and it doesn't have a clean answer. If the system continues operating on the logic of global price interconnection, of geographic choke points, of debt-constrained governments with shrinking fiscal room, what should individuals actually do? Not in terms of specific trades, but in terms of how they think. Does your current financial picture account for the possibility that energy prices remain elevated not for months, but for years? Does it account for a dollar that may face additional pressure? For food costs that may not return to where they were? If you have children just starting out, buying their first homes, making their first investments, the economic environment they're entering may be structurally different from the one most financial plans were built around. That's not a reason for panic, it's a reason for clarity. Now, to be fair, this script frames the issue from the angle of economic pressure on households and consumers. That's one lens, and it's a valid one. But the full picture is more layered. Energy markets also create stability for producer nations, revenue for pension funds invested in energy companies, and employment for millions. Strategic petroleum reserves exist precisely to buffer short-term shocks, and international coordination from bodies like the IEA has historically helped stabilize disruptions. Some analysts argue that markets are already pricing in de-escalation scenarios. That flexibility remains. That technological change in energy, renewables, efficiency gains is quietly reducing long-term dependence on any single choke point. The system is not simply a villain. It's a mechanism with multiple actors, multiple interests, and genuine counterweights. Understanding it fully means holding both the pressure and the stabilizing forces in view at the same time. Events like this tend to fade from the headlines eventually. Tensions ease, markets stabilize, the news cycle moves on. But the underlying structure, a global pricing system tethered to a 21-mile waterway, operating inside an era of constrained fiscal response that doesn't disappear when the news does. The disciplined investor, the careful household, the person thinking 10 years ahead, they're not asking, will this specific crisis last? They're asking, if the incentive structure doesn't change, what does the next version of this look like? That question is worth sitting with, not as a source of fear, but as a source of focus. Because in the end, the strait may close and reopen, but the logic that made it matter will still be there. Events fade, structures remain. The question is whether you see the structure before the next event arrives.